Hello, happy Thursday. I hope you're staying warm this week. It's certainly starting to feel like winter very quickly. We've got a lot going on this week. We got a first kind of glimpse at the jobs market data, which has been showing strong so far, but the big numbers tomorrow. And of course, here we are again, the Fed press conference and announcement just yesterday on Wednesday that we're going to break down. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news and data and weed out some of the noise along the way, which this week, although there's a lot of noise too, has a lot of stuff to kind of hang your hat on. So anyways, hopefully you're staying warm here this week. It's definitely starting to feel like fall. I was actually at the casino up in Tulalip last week, and really ever since it's gotten much colder. Side note, I actually won some money up there for the first time in my life. So that was a good sign. Anyways, we'll jump into it. So the first thing I want to touch on is very brief. And then most of our conversation today is going to be on the jobs market, and it's going to be on the Fed from yesterday. So the first thing I'll touch on is consumer spending came out last week. That number was up. Consumer spending was up 3.8%. So it's good to see that, in light of everything that is going on in this economy, the consumer is still strong, still spending. But where things start to go sideways is the jobs market. And where I'm going with this is that although the jobs market data would show that things are very strong, what this means, of course, is that the Fed feels very confident they can keep on hiking. So basically, let's start with the jobs data we know so far. We'll pivot into the Fed, and then we'll talk about the jobs number tomorrow. So far this week, we've gotten a few job data points. The first we've received is job openings, which came out on Tuesday, I believe, and it was 10.7 million job openings. So much higher than expected, actually increased from last month, and is getting a little closer to where we were before we saw a very short pullback in the job openings number. So again, 10.7 million job openings, much higher than expected. On top of that, we had ADP employment report come out yesterday before the Fed announcement, and that showed 239,000 jobs added. Still remains to be tested, this ADP employment report, because they took it off the shelves, so to speak. They stopped sharing it and they revamped it, and now have gone, I think, 2 months since the new system. But regardless, this was a good indicator last month for non-farm payrolls, which comes out tomorrow on Friday. And again, this number was higher than expected. We added more jobs, if this number is accurate, in the month of October than many had expected. Now, what that means for the Fed, again, is that we've got a strong jobs market. Basically, what these numbers are telling us is that regardless of what's going on, labor market is still very strong. Now, keep in mind, a lot of these data points, you could take them with a little grain of salt because they're not perfect by any means. But regardless, it's showing that there's a lot of job openings. There's a lot of jobs that are being created, or I don't want to say created. Let's say maybe recreated or filled, maybe is a better way to put it. But anyways, the way that the Fed sees this is that if they're looking at inflation and the labor market, they're looking at this saying, well, we're not scared of completely upending the labor market yet by raising rates. And so here we come on Wednesday. The Fed did exactly what I think many thought they would do, which was raise rates by 75 basis points. Now, what really starts to tell a story is what came between that, what they shared after in the press conference. And what I think is really interesting is why the markets just keep thinking they're going to slow. I mean, we saw the markets up pretty big the last few weeks. We saw the markets up really big when the announcement was made at 75 basis points, because they were hanging on one sentence that basically said they would consider slowing. And then, when he went into the press conference and shared more details, the markets just pulled way back. So it's very clear the market is just speculating like crazy on this idea that the Fed is going to slow, which will happen at some point. And I think could be, kind of a catalyst for some growth in the market. But, it's just so funny to see every word, how much is being hung on there. So anyways, let's talk about the press conference, which I think is what is more telling and what is, kind of drove that pullback at the end of the day there yesterday in the markets, and to some degree into today as well. basically what the Fed said is that they are unclear on what interest rate increase is going to be sufficient to reduce inflation or get them to an inflation number they feel more confident. But they said they still have room to go, and they also shared, which I thought was really important, that it's likely that interest rate is going to be much higher than they had expected. To me, this just signals we're going to keep going, we're going to keep going, we're going to keep going. But again, the markets have been doing some crazy stuff. They said they're going to stay the course until the job is done. Time to slow is coming, and maybe as soon as next meeting or the one after, which is where we saw the markets pick back up again, and then said very premature to even think about pausing hikes, and then we saw the market pull back again. So I think that, what I kind of gather out of this conference was that basically the Fed's doing exactly what they said they would do last meeting. They talked about 75 or 125 basis points by the end of the year. They did 75 basis points yesterday, Wednesday. And I think if they're talking about possibly slowing coming as soon as next meeting, although the markets, I think, took that for more than it might be, I think all that means is that next meeting in December might be a 50 basis point hike again, right? We'll see. There's a lot of data between now and then. As a bit of a tip of the cards, we've got inflation next week. But I think the gist of it is that the Fed is going to slow down this inflation thing. They're not concerned about the labor market yet, and they're going to continue to be aggressive. Now, that may mean slowing the growth of these rate hikes, but as far as stopping them, I think we're in 2023 at least before that happens. All right, so I hope that is helpful. Obviously, a lot here this week. Coming up next week, we've got some good stuff. We've got non-farm payrolls data tomorrow, so we're going to talk about that and the impact of that on this Fed talk and jobs market and all that. But maybe biggest things are number one, the election day on Tuesday. Election is going to be a big piece as markets and tax landscape goes moving over the next 2 years. Plus, we've got CPI data coming out on Thursday, which again is what the Fed's really watching, right? We're watching inflation. All right. Before we jump into next week, and we'll look forward to seeing you next Thursday to really break all this stuff down. It seems like there's no breather these days. But anyways, we had a great question of the week this week from Mark. So Mark, keep an eye out for a Starbucks coffee on me here soon. But Mark basically was asking about 2023 401k contribution limits, which is very timely. We actually just wrote a blog on this as well. But basically, there's data out. IRS has come out with 2023 contribution limits, and it's the biggest jump we've seen since they tied the contribution limits to inflation. But really, to be honest with you, it's not that big. So basically, what's going on is we've got an increase of $2,000 contribution limit for 2023. Not this year. This is for next year, 2023. So next year, 401k contribution limits jump up to $22,500. But the kind of nice thing is that there's a couple more additions as well. Catch-up contributions are also rising. So for those age 50 or older, you can put in a total of $30,000 next year in 2023. Okay. Also, IRA contributions also finally increased as well. So IRA contributions in 2023 are going to increase to $6,500 per year. So in total, if you can do it, or whether it's Roth or IRA or deductible or non-deductible, regardless, if you're age 50 or older, it's $30,000 to the 401k, and then again IRA contributions bumped up to $6,500 for next year too. Mark, thanks again for that question. I think it was really timely and a great thing to kind of think about as you gear up for end of 2022 and some planning into 2023. Thank you, as always, for joining us, everybody. We'll look forward to talking more next Thursday, where we're really going to break down the non-farm payrolls, the election results, and, of course, inflation next Thursday at 3. Have a great upcoming weekend. Stay warm, and we'll see you next week.